As the world looks toward 2026, a maelstrom of economic and political forces converges. Upon a single critical question, will the U.S. Federal Reserve continue its path of monetary easing, or will a new reality force a dramatic change in course? After 3 interest rate cuts in 2025 failed to wrestle inflation back to its elusive 2% target, what new variables will shape the global financial landscape? Will the world's most powerful central bank bow to political pressure, or will it chart a fiercely independent course through treacherous economic waters? The fate of global markets, the strength of the U.S. dollar, and the stability of the international order may well hang in the balance. How will the impending change in leadership at the Federal Reserve reshape its very identity and its approach to monetary policy? The path forward for the Federal Reserve in 2026 is shrouded in a fog of unprecedented uncertainty. The series of rate cuts initiated in 2025, intended as a measured response to a cooling economy, has left policymakers in a precarious position. Inflation, though tempered, remains stubbornly elevated, a persistent thorn in the side of a central bank committed to price stability. This has ignited a fierce internal debate, creating a stark division within the Federal Open Market Committee. On one side are the doves, who argue that with the labor market showing clear signs of deceleration, further easing is necessary to avert a more severe economic downturn and ensure a soft landing. They point to slowing job growth and moderating wage pressures as evidence that the engine of the American economy is losing steam, and that preemptive action is required to prevent a stall. In their view, the risks of over-tightening now far outweigh the risks of slightly persistent inflation. Conversely, the hawks within the Fed raise a chorus of caution, warning that the battle against inflation is far from won. They contend that cutting rates prematurely, especially when inflation remains demonstrably above the 2% objective, would be a grave policy error, risking the unanchoring of inflation expectations and squandering the hard-won credibility gained over the past several years. They argue that the labor market, while no longer white-hot, is still robust by historical standards and does not signal the kind of emergency that would warrant a continued dovish pivot. For this faction, a higher-for-longer stance is not a choice, but a necessity to ensure that the inflationary pressures of the post-pandemic era are definitively extinguished. This internal schism means that consensus is fragile, and expert predictions of a single token rate cut in 2026 might vastly underestimate the potential for a more volatile and unpredictable policy trajectory. Adding a powerful and destabilizing element to this delicate balancing act is the looming influence of the U.S. presidential administration. The White House, keenly aware of the political implications of economic performance, has exerted considerable and often public pressure on the central bank to pursue a more accommodative stance. This creates a challenging dynamic for an institution whose effectiveness is fundamentally predicated on its independence from political interference. The administration's agenda, which includes sweeping changes to tariff structures and new restrictions on immigration, introduces a host of variables that complicate the Fed's calculus. These policies have the potential to simultaneously be inflationary, by raising the cost of imported goods and restricting labor supply, and deflationary, by disrupting global trade and potentially slowing aggregate demand. The Fed is thus tasked with navigating the economic fallout of policies whose full impact is difficult, if not impossible, to model, all while trying to maintain its apolitical posture. The most significant wildcard, however, is the leadership transition set for May 2026. The end of Jerome Powell's term as Federal Reserve Chairman marks a pivotal moment that could fundamentally alter the institution's direction for years to come. The selection of his successor will be a battleground for competing economic philosophies and political agendas. Should the White House succeed in appointing a chairman more aligned with its preference for lower interest rates, the central bank's policy path could shift dramatically. Such an appointment would be interpreted by markets as a clear signal that the Fed is willing to tolerate higher inflation in pursuit of other objectives, such as maximizing employment or accommodating government spending. This would not only amplify the downward pressure on the U.S. dollar, but could also call into question the very foundation of the Fed's long-term policy framework. The identity of the next chairman is not merely a personnel change. It is a decision that will redefine the Fed's reaction function and its relationship with the executive branch. In this vortex of conflicting signals, the US dollar is caught in a powerful downdraft. Poised for what could be its most significant annual decline since 2017, the consensus on Wall Street is coalescing around a narrative of sustained dollar weakness. A forecast predicated on the assumption that the Federal Reserve's easy cycle will outpace that of its international peers. As major investment banks project a continued slide in the greenback, global capital flows are beginning to recalibrate, seeking higher yields and more favorable growth differentials elsewhere. This weakening of the dollar could have profound implications. It's providing a tailwind for U.S. exporters, but also potentially stoking domestic inflationary pressures by increasing the cost of imports. It is a double-edged sword that the Fed will have to manage carefully. Yet to declare the demise of the dollar would be a premature and simplistic conclusion. A powerful counter-narrative is emerging, centered on the transformative potential of artificial intelligence. The United States remains the undisputed epicenter of the AI revolution, and the massive wave of investment pouring into this sector could act as a potent engine for economic growth. This technological boom has the potential to drive productivity gains and innovation at a pace that far exceeds that of other advanced economies, particularly in Europe. If this AI-driven exceptionalism translates into superior economic performance, it could provide a formidable floor for the US dollar, attracting a torrent of foreign investment and offsetting the effects of a dovish Federal Reserve. The dollar's future, therefore, is not a simple one-way bet, but a complex interplay between monetary policy divergence and the powerful. A symmetric shock of a technological revolution. What happens when a central bank's mandate for price stability collides with the political pressures of an election cycle and the disruptive force of technological upheaval? How can any institution maintain a coherent long-term strategy when faced with such deeply entrenched internal divisions and external shocks, as the world navigates the transition to a new leadership era at the Federal Reserve? One must consider how the very definition of central bank independence might be rewritten. Does the relentless advance of technology, like artificial intelligence, render traditional economic models and monetary policy tools obsolete? In an era of such profound uncertainty, is the pursuit of a precise 2% inflation target a realistic goal or a quixotic quest?